Hey everybody, this is Mark. Welcome back to Beyond Profit, a global perspective. And in a previous video, we talked about currency, right? What affects its value. We talked about how supply and demand affects it, how confidence affects it. In this video, we're going to talk about how money supply affects exchange rates. So let's get into it. So let's start with this question. What affects the relative value of currency? And the answer, pretty straightforward. We talked about supply and demand, right? The answer is money supply. So what is going to affect the amount of supply of that money that's going through a system, right? Well, there's a number of things. One could be the economic activity of a country, right? The more productive you are, the more your GDP grows, you get growth. That means there's a lot more money flowing around, and obviously, the more of something that's flowing around in the economy, the more the value of that currency is going to go down. Trade flows, right? If we end up selling a whole lot of exports and then a whole lot of money comes back into the country, then that also is going to affect the value of the currency, having a tendency to make it weaker, right? Bring the value of that currency down. So growing our exports can potentially be inflationary. Another factor that affects currency value and the supply of money that's in an economy is lending practices. If it's easy to access credit, then that means more people are going to borrow money. It may not be real money that they have or real money that they're able to pay off, but it's certainly money that's going around the economy and stimulating it, which de facto increases the money supply. One of the problems, though, is that when you have a lot of borrowing that occurs without the actual ability to pay it back or without the assets to back it up, it can create bubbles. And it's this sort of thing that led to the economic crisis of 2007 to 2008. Another factor that affects the relative value of currency is government intervention. And that comes in a couple of forms usually. One is through fiscal policy, and the other is monetary policy. Fiscal policy is the use of government expenditure and revenue collection to influence the economy. All right, so most frequently, like let's say that the economy's not going so well, it's slowing down, you've got a recession going on, what policymakers tend to want to do is put more money into the economy. Now, depending on if you're a Republican or Democrat, you may do that different ways. Like Republicans might say, hey, let's cut some taxes, and maybe they'll spend some of that money with the taxes they lost, or that they get back, and that maybe that'll cause some stimulation of the economy. Democrats are a little more like, hey, I'm not sure just giving people tax cuts is going to do it. Let's put money into the poor people, the people who actually don't have that much to start with, and they will actually spend the money, and that might actually stimulate the economy. And you got different perspectives in terms of how that's going to happen. But the fact is that when you're putting money into that economy, that's going to affect the value of your currency. Okay, so you put a lot of money into the economy, that's going to stimulate things because people are going to start buying stuff, they're going to spend more stuff. But as that money starts to increase, start to circulate, what happens to the value of that currency? Right, value goes down, exactly. So isn't that ironic, right? I'm putting more money in your pocket and the value goes down. On the other hand, sometimes when economies are heating up too much, or for whatever, for principle, or who knows, people have their reasons, they want to cut spending of various sorts, or they want to increase taxes. That has the net effect of taking more money out of the economy, but then also it increases the value of it. So yeah, ironically, I may raise your taxes, but what you got in your pocket is actually worth more than it was yesterday. That's the stuff the politicians don't like to talk about. The other side of the implications of all of these things is that for every action there's a reaction. So a second mechanism that affects currency value is monetary policy. And that's where a central bank controls the money supply, oftentimes through interest rates. And this is where things get weird, because I've been teaching this class since, I don't know, the year 2000, I think maybe. Like literally, that's a lot of years to be teaching this class. And when I started teaching this class, this was before the financial crisis of 2007, 2008. And if I were to tell people about this, I would say, okay, let me tell you about the Fed, the Federal Reserve Bank, right? Whenever the economy starts weakening, then they're going to decrease interest rates. And why does that matter? Well, if you decrease interest rates, then all of the banks are more or less going to follow suit. And that means that if I want to get a loan for a car or a house or something like that, that means that I'm not going to have to pay as much back in interest. And that's going to give me more incentives to want to buy a house. If I buy a big house, that's a big expenditure. That's going to stimulate the economy. That's a lot of money going around the economy. I might make big purchase like cars or major appliances and things like that. That's a way to sort of jumpstart the economy. You cut those interest rates. Likewise, if you get an economy that's too hot, maybe inflationary, you turn around and you raise those interest rates because the idea is that will cause people to buy less stuff, right? I'm going to buy fewer cars, fewer houses and stuff like that with less money going around the economy. It's going to change the value of the currency and it's going to affect, the level of stimulation in the economy. And that would have been sort of the end of the story in 2006. And 2007 comes around and we get Bear Stearns, and then we end up with like a major financial crisis with the real estate market and blah, 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 and everything else. And suddenly monetary policy is crazy. It's like Congress can't decide what to do. They can't even come up with $1 billion to try to stimulate what is the worst economy we've had since the Great Depression. And so what happens is the Fed steps in, they start bringing down interest rates to zero, which is the same thing they did in the pandemic, by the way, which helps. It's great, but it's also, they believe, not enough. So what does the Fed start doing? During the Great Recession, home values fell, plummeted. They decided, hey, we need to stop this from happening, and Congress isn't doing it. Nobody else is able to get a handle on it, so they started buying up homes, just taking over the mortgages. The Fed owning like most of the mortgages in the United States. A lot of them, of course, coming from bad derivatives, and I don't want to have to get into the details of all that. A little tangent, but suffice to say, that's a major influx of money in the economy in a way to sort of reinforce the confidence that would have in their property and therefore the currency. And then we do things like quantitative easing, QE they call it, or the second round was known as QE2, not the Queen Elizabeth II, the famous luxury liner, but no, Fed policy, the QE2. And the idea behind it was that they're basically just going to add zeros to bank accounts, not bank accounts, but to the value, to the credit of a bank, so that they can, hypothetically anyway, lend more money. It's just like Guy was saying, it's like printing more money. And we're going to put enough stuff in the economy so that small businesses can have access to credit, which didn't work quite like they thought, but that was the idea. Let's put more money into the economy to get this thing going again. And that was it. That was quantitative easing. Essentially, somebody at the Fed basically saying, okay, bank, you get more money, and bank over here, you get more money. And the economy was so bad and demand sort of was enough that it didn't, for as much money that they put in the economy, it didn't create any inflation. It's just like it just sucked it up like a sponge because there was that much demand for stuff and not enough money to go around, so there's just more and more money to go around. And I will also say that in that decision that we made, it actually put us at odds with our European counterparts. So Europe, at the same time, they're facing the same sort of crisis as we are. But instead of trying to spend their way out of a recession, they believe that they need to become fiscally tighter. So it's sort of the opposite logic of what most economists would say. You spend during a recession, you save for a rainy day, then you spend on a recession. These guys were tightening their belts. And that was a challenge because Germany is a major exporter of products, and we import a lot of stuff from Germany, and we compete with Germany in a lot of markets for a lot of the same exports. So think about this for a second. Let's say we put a whole lot of money in our economy, which is what we did with quantitative easing, okay? What happens to the value of the US dollar if we start doing all this stuff? We're putting money in the economy through quantitative easing, we're putting more money in the economy because of buying up bad loans and stuff in the housing market and stuff like that, and we're spending almost $1 billion in Congress, right? What happens to the value of the dollar when you do all that stuff? Value goes down. So let's apply that logic to what we were talking about in terms of the value of currency and what you might do in terms of international business. Let's say you're in Japan or something, right? And you got a German product on the shelf next to an American product on the shelf. And the value of the American dollar is low and the value of the euro is high. Which one's going to cost more?
The German product.
Exactly. So if you're a Japanese person and you're choosing between the two, you're probably going to be more likely to buy what? The American product, right? Okay. So how do you think the Germans are going to feel about that? Yeah, not very happy with us. So the Germans are pissed off at us because this is our response to the financial crisis. They're thinking that their entire export market is going to be wiped away because of American domestic policy. They were wrong. It really didn't affect their exports that much because it didn't affect the value of our dollar nearly as much as we expected it would, because our depression was, recession, depression, whatever. It was so horrible that our economy really needed that money. So in a previous video about currency, we just sort of talked a little more generally about the idea of supply and demand and how it might hypothetically affect currency rates. In this video, we took a much more empirical look at it, right? We looked at fiscal and monetary policy, plus a lot of other reasons why money might be floating around the economy and causing rates to go up or down. Understanding how this works is really helpful if you're doing research, right? Specifically, if you're trying to take a business overseas and you want to know what might cause exchange rates in a certain country to go up or down, it might be worth looking at some of this stuff, right? What is the central bank doing there? How much money is the government spending? What's its tax policy, right? How easy are loans available? All of this stuff might have some impact. Certainly hope you found this video helpful. As usual, please like, subscribe, share here, and thanks a lot for watching. We'll see you next time.